Hi and welcome back to the Village Trader Podcast. I'm your host Njabulo Nsibande. This podcast is aimed at helping new and experienced traders navigate the markets and learn from other traders. This is episode number 34. In this week's episode, we're chatting Gamestop and why Nassim Taleb and Mark Douglas were right. So today I'm chatting with a good friend of mine, founder and chairman, CEO of Finance Hut. So we're going to be chatting Gamestop, full by randomness and that sort of thing. How are you doing, man? How are you doing? Mr. Lesegesha Mthiyane.
Well, man, you guys live far, bro.
Maybe you're the one that lives far.
Yeah.
To get a bit of context, he's from Pretoria. I'm from the East Rand. Worlds apart.
2 highways apart.
Yeah, it's quite a
Maybe
distance.
3 somewhere, Mara. Yeah.
From Pretoria to here, might be 3.
Yeah.
Might be 3. Might be 3.
You found respect.
Yeah, man. Anyway, to get to the cracks of the matter, I want to address Gamestop and the short squeeze that we saw over the past, during Jan of 2021. So briefly explain for those who don't know what shorting is. Shorting is selling what you don't own to profit on its downfall. So essentially, if I borrow my friend's car, Lesegisha, and sell it to the market, I borrow it at 10,000 Rand, I'm going to sell it at 10,000 Rand immediately on the market. And as the value of it depreciates, and then I go buy it back for 9, I pocket the 1,000. Except Lesegesha can choose to put rims on it, sound on it, making it more valuable so that I'm now buying it at 15,000 Rand, losing the 5. So that's essentially, the shorting, briefly explained, and tried to make it as simple as possible. And then a short squeeze happens when Lesegesha doesn't stop pimping the car up, and the value of the car doesn't stop going up. So the risk on when you're short on anything is infinite because the price, the numbers going higher, they don't have a limit, as opposed when you're long, buying, with anticipation that the stock is going to go higher. So your risk when you're long is just 100% because the stock can just go to 0. But when you're short, your risk is infinite because there's no limit to where the price can go to. We saw it with Tesla. We saw it with VW around 2008, where VW was probably the most valuable company for that period in the world because of a short squeeze. So a bunch of hedge fund managers saw that GameStop was dying, a slow death, as they put it. So they decided to short GameStop, except they were heavily short. It's an understatement. They were short quite heavily on GameStop. In fact, about 140% of the stock was shorted. So they short sold more stocks than there is floating in the market on GameStop. So there's a group of guys on Reddit and Wall Street Bet who saw that opportunity and decided to squeeze them out. They decided to drive the price a little bit high, just enough to squeeze the short sellers out, because as the price is rising, when you're short, you need to buy back. To exit your position and cut your losses, you need to buy back the stock, pushing the price further higher, because the volume on those shorts was quite high. So these guys saw that opportunity and they placed they bet. And hedge fund managers were losing their bets until brokers limited trading on the long side on GameStop. So I wanted to chat about with GameStop and what happened. So essentially that's what happened, and that's the risk that shorting has. And let's chat a little bit about the asymmetrical bets that these Redditors or Wall Street Bets guys took against the the hedge fund managers, because this was not I don't think this was a fundamental trade where they were looking at earnings, profits, or whatever and said this is a good company, let's bid it up. It was more of a technical approach. We're seeing a huge bunch of shorts, and we see that we can squeeze them out, and let's do that. So let's talk about that asymmetrical nature of this beast.
Yeah. So in essence, the asymmetry comes from I can put in $100 into GameStop, and that's all I'm gonna lose if I'm buying the share. And for as long as you're still shorting the share, the asymmetry is the fact that you will go as high as, or as long as you're still inside the short, I know you're always gonna be a buyer. You're always gonna be there to buy my share because you have to buy the short, or you have to close the short.
Yes.
So the asymmetry comes in that, in essence, the higher we keep pushing the price, the higher it will keep going, and all we can ever lose is 100% of our money. Whereas in your case, you can lose, as you mentioned when you were defining what a short is, you can lose an infinite amount of money. If the share gets to $1,000, you shorted it at $3. The percentages are bigger than my small brain. Yeah. So I think that's the asymmetry risk that was taken on there. Infinite upside with limited downside. And it's the same for the hedge funds. They just did it in the opposite. They take infinite upside risk and limited downside risk.
Yeah. And this behavior of hunting certain trades or hunting certain positions is not a new thing. I mean, hedge fund managers hunt stops all the time. They look at areas where retail traders would put their stop loss and just hunt those levels, right?
Yeah. It doesn't get popularized as much, but it does happen. Yeah,
except this time the little guy did the exact same thing that the big guys are doing on them. So what went wrong? How did in inverted commas so many smart guys were outsmarted by the outsiders?
And you see, it starts with you saying what went wrong, and then I'd ask for who and what have you. And thank you for qualifying the question. Say, how come the smart guys were outsmarted? Remember, a lot of investing relies at least on the efficient market hypothesis. The notion that the stock market knows everything and has reflects all information in a stock price. And then what we know is that there are certain advantages that other people have that others don't have on this earth, right? Inside information, access to funding, access to cheap capital to pump into stocks. So as far as what went wrong, look, there's what we can see is happening, and then there's maybe what will come out over the next couple of months, years, as each hedge fund guy gets interviewed and they explain their position. But in essence, what seems like went wrong is whatever advantage they thought they had ended up being called out, and it ended up showing itself not to be an advantage. And that advantage may not necessarily be the knowledge that GameStop is going to zero. It may have been if you think about it, it actually somewhat did play out to a certain extent. The share didn't go to $1,000, not because the little guy ran out of money, but because exchanges intervened and said, no, you can't buy GameStop, Nokia shares, what have you. So as far as what went wrong, maybe the exchange intervened later than the hedge funds thought they would have intervened. So I think that's what went wrong. If you ask me, I think that's what I think the hedge fund guys were counting on. They were counting on the fact that regulation will always stop this sort of behavior.
Yeah, but for years, hedge fund and big capital have been preaching for free markets, right? So and the ability to buy and sell shares. Why couldn't they factor that regulation may step in late because they requested free markets? Maybe not them specifically the ones that got squeezed, but
Yeah.
you know, capital markets have been wanting free markets, and the same free markets, you know.
That's an assumption we're making. It's difficult to put it down to who has ever said they want free markets. I'll give you an example. I like a share. It's cheap. It pays good dividends.
Mm-hmm.
I don't want free markets to come in there, because if a free market comes in and I can only buy so much of that share that before the share price moves to its fair value,
Mm-hmm.
then I get a small portion of what I would have liked to buy. So I'll give you an example with Nsibande Gold, for example.
Mm-hmm.
A company that at 7 rands, I was comfortable that they're going to pay off their debt and just pay out chunks of dividends.
Mm-hmm.
But at 7 rands, I didn't have any money. 3 years later, the share price is 63 rands. I've got some money to throw into the market, but the free market has recognized the value that lies in Nsibande. So I think we might even need to go back and say, you see, there's a concept that we function in free markets,
Mm-hmm.
and the notion that we want free markets are two different things. So,
But that ability to because now we're getting to places where we wish for something not to happen because of our immediate restrictions and limitations that we have.
Yeah.
But had you had the capital to buy Sibanye at 7 rand and whatever the case is,
Then once
you
I'm
want
in,
the free market.
Once I'm in, I want the free market to take its place and value it at the correct amount,
yeah,
so that I can realize my value. I can get price discovery.
yeah.
Yeah.
And that price discovery and the price fluctuations come from you and I disagreeing on the value of
Yeah,
Sibanye.
yeah. And to your question now, ne? The reason why then I'm imagining that then complain is because you want it, but you don't always want it. You want it at certain times, at certain places. Where they got it wrong, again, maybe the notion that they didn't think it was going to happen.
So,
Yeah.
which brings us to something, one of the key principles that was touched on Trading in the Zone by Mark Douglas.
Yeah.
We as retail traders, as newbie investors or traders, for lack of a better, we're constantly being told you don't need to know, or you can't possibly know what's going to happen next in the market for you to make money or not to make money.
Yeah.
So if you're saying these guys didn't think or didn't believe that they that's going to happen, it's them just saying they know exactly what is going to happen next, which I suppose could be where it all went wrong for them.
Yeah, to a large extent, but I don't want us to undermine that. You know, it's the same as your kid saying one day that he's going to outsmart you. You know, you're sitting there laughing, thinking, "I wish he knew that I've been through it all."
Yeah.
Including raising him. You know. So to an extent, there's a level of you that will take him for granted that he can get away with what he's doing, such that while it's happening, not even sometimes you're aware of what he's doing, but you maybe are relying on your other controls that you have in place to maybe bring him back in line, not realizing that even they will fail you. So maybe you let him sneak out the door, knowing that you locked the gate, only to find that no, he's gonna sneak out the door, and for him, once he's out the door, he was planning to jump the fence, whether the gate is locked or unlocked, you know.
Yeah.
So I think it's it's a play on, and it's a reality. You know, I was listening to Annie Duke again this week, thinking in bets, probabilistic thinking, all of that, and one of the things that stood out again, she said a quote: "We have one version of history, but many versions of the future are possible." And hindsight bias is what we then even now do, where we look back, we've got the outcome, and now we're saying that these guys are stupid. I mean, remember, these are people that, I mean, they're managing 5 trillion. You know, they're managing more money than you and I have ever had. So, you know, to just say that they took something for granted, you and I here with our little bank balances, it's us hypothesizing, and we could be so far off the mark. You could find that for them they really don't even care. Okay, it's difficult to say when one of them has went under now, but it's those little things that you'd have to know and get a full set of information to see what were they considering. As I say, the immediate one that jumps to me is so one, legislation will should have either prevented it, so they didn't think it would happen. Secondly, when legislation shows that it does take its sweet time, the next thing that they were counting on actually did kick in, which is Robinhood, easy equities through the US broker, all those guys. Obviously, easy equities doesn't have GameStop, it has Nokia, but same universe, right? They stepped in to say we're no longer gonna allow trading on this counter, which is what the shorts would have always known, that the guys on Robinhood, worst case scenario, if they send a share skyrocketing, the exchange can step in and limit those trades, which actually did happen. So part of the risk that they had evaluated, they actually kicked in. The third one, which is probably what I think we're going to see, it happened with the guys by Bitcoin, is it's fine, I can take the damage now, but later on lawsuits will follow and I will recover that money, or I'll recover those suits, whatnot, as we have with pyramid schemes. Pyramid schemes, sometimes the regulator allows them to run for a while, knowing that it's the long arm of the law. At the end of the day, we're gonna come for you and we're gonna get the money back. So it could also be that let the trade run as should be, and I'm gonna use all my legal remedies to come back and get the money back from the
Wall Street bet.
Yeah, the Wall Street bet guys.
Yeah, but Wall Street, like what Wall Street bet guys were doing was not illegal, and they were not doing it in secret. It was like in public, in plain sight. And also, my problem, at least with the benefit of hindsight, why I call this trade stupid on the side of the hedge fund managers is not because they lost money. Everybody loses money on the stock market, whether you long or you short. Everybody loses money on any random trade. Anyone will lose money. The stupidity comes in not stopping the bleeding, because and you can see this, that they didn't stop the bleeding when the bleeding started. And granted, the bleeding was very quick, was violent, and it was very quick on them. If you say, whenever you take a trade, whether you take it based on your fundamental reasons or you take it based on your technical reasons, you should have at this point I'm wrong price, or at this point I'm wrong reason. When you're fundamental, you say for example, if the debt exceeds the revenue, then I'm wrong on this company, I need to exit. Everybody needs to have that predefined risk, and when that happens, you exit, no questions asked. And granted, when without the help of regulations and clearing houses halting trades and that sort of thing, they were going to get squeezed. That was going to happen, because now, at least now, we know that the Gamestop, Wall Street bettors were on the other side of the trade. But as they were getting squeezed and they were exiting their positions, that bleeding would have stopped at some point. But it didn't stop, because they kept on it, and we can see them on the news crying, saying these guys are stupid, these guys are crazy. They make the markets irrational, and everybody knows that markets can be irrational for longer than they can remain solvent.
Yeah, true. So I'll start with you saying Wall Street bet guys didn't do anything illegal. Nah? If I lose $7 billion, I'm gonna test that in court. I'm not gonna let a news channel tell me they did nothing illegal. I'm gonna take them to court and test it there, get some sort of a court ruling, and then cascaded down. That's the first, right? The next one is the notion of at some level you should stop, and then you gave all those disclaimers, minus regulation, minus whatever. Truth is, all those things you minusing, when it was happening, they were there. You can't after the fact say, assuming there was no legal recourse, whatever. As I'm losing money, I know I've got legal recourse. I can't assume I don't have legal recourse. The other thing is, when you reach a position of FU money, and I'm speaking now, hypothesizing, nah, it's not about the money. As much as it is about the money, it's not about the money. In other words, whether you lose 1 billion or you lose 7 of them, it's still the same principle that maybe you're fighting there, where you're still going to have a warm bed at night, posturepedic, what have you. You're still gonna drive home in your Ferrari, Maserati, go home to your big house, whatnot. So it's not like it's got a lived impact on you, That's why it's FU money. In other words, it doesn't affect your existence as a person.
Okay.
It affects what you do and what you do on the daily. And so you probably may leave yourself exposed a little longer than you should have. And I'd like to think, for you to get to that net worth, you had to have done something. You had to have broken some of the rules that you and I are going to observe religiously to get to that level of trading. Obey your stops, set trailing stops, those sort of things.
Cutting your losers and stuff.
What have you. And I'm saying that, look, and this is me hypothesizing. I'm going to end up coming off as if I'm a hired spokesman. The other guys. But I'm being fair to the discussion because I don't think it helps you if I bring the obvious things that we have to. It's a thinking exercise. We have to consider, why would someone who's clearly smarter than 99% of the universe in terms of their ability to create enough value that 7 billion accrues to them, why would they all of a sudden act so irrationally that guys in shorts on Saturdays can just say to the rest of the world, this was clearly a mistake on their part. They have to have been doing something that is a lot more not so obvious. Yeah.
As you're talking about their personal lives not being disturbed, at least not in the same magnitude as their portfolios were.
Yeah.
Do you think perhaps the lack of skin in the game on the part of the person, the fund manager themselves, plays a big part of it? To say, sure, I may lose 1 billion, but it's not my billion. It's 1 billion under management. It's not my billion.
I think we'd have to research the actual firms that were involved and find out how much skin in the game the actual guy on the ground had. But if you want to talk about skin in the game, that's always a risk that you have when you don't have skin in the game. You're going to risk the client's money. Obviously, as well, it's a play on confidence. You also back yourself that if I lose 50% of your money, I'll get it back as long as you keep giving me a chance. To make that thing, to keep playing in the market. So it definitely is. It's the classic flow of no skin in the game.
Because we can't call this a black swan, can we?
So
because this is not the first short squeeze.
So you'll have to find the black swan element of it, and that's the thing about a black swan, the fact that the minute we can reason it diminishes its black swanness. So what's not a black swan? A black swan being a short squeeze is not a black swan, not at all. A short squeeze in this manner may be a black swan, and there's this guy Jamie Cathywood, Investor Amnesia. If you go on his website, he writes investing history, and he covers almost everything. Electric EVs. There's almost nothing new under the sun that occurs today that didn't occur at least 100 years ago, right? So it becomes one of those where you're starting to play on a certain niche way in which things unfolded that makes it a black swan. So the fact that in any other time in history, you did not have retail investors at this scale being able to coordinate a trade. which the coordination itself is another black swan, because well, not a black swan, but another exponential leveraging of exponential technologies. You know, now we're moving into your fourth IR whatnot, where you're starting to see a lot more of these events happening, where there's a convergence of a lot of advances in a lot of areas. So shorting itself is an advance in finance. Then democratized investing. Is itself a innovation in investing. Then easy equities took it a step further with fractional share investing. That's a step further. Then the ability to communicate on platforms online. That in itself is an innovation in communication. The ability to do it on a platform like Reddit versus Twitter, for example, where on Twitter you'd probably just have a bashing conversation back and forth. I hate you back for shorting GameStop. I hate you for whatever. Whereas on Reddit it's another innovation of Twitter in inverted commas, where there's that added element of taking action to it. That eventually, when all these things came together, they converged and created a black swan. But to pinpoint and say this part of it was the black swan of it, it becomes near.
Because we had a short squeeze on Tesla not very long ago, and the risk of the infinite risk nature of being in a short position has always been there. And it's not something new. It has always been there.
And maybe that's where now, because remember, black swan is and I'll be paraphrasing. It's a random event, but also there's a second part to it with a certain impact. So now you have on the one side all these advances that have converged together to create this action. And to your point, them not stopping the bleeding allowed the impact to be so big that it actually completed the definition of a black swan. That if they had cut the impact at some point, we would have just said the convergence of all these advances or technologies is a phenomenal thing. By the way, that's actually what I even hope we can touch on a bit, how phenomenal this whole sequence of events was for other things other than the fact that rich people lost money, right? So you may find that alone would have been a very noteworthy occurrence in history. The fact that it then even had the impact that it had in terms of the amount of money that was lost completed the second part of the definition of a black swan, the impact then that it has on you.
Perhaps we should maybe start looking at as the money that was made.
Funny man.
The money that was made, because
can you say temporarily made? Because here's the deal, and this is why I say I don't want us to ignore the imperfect market hypothesis. The fact that you actually do have people stepping in, and I think that's where you find me then, not as a spokesman for rich people on the other side. That it's unfortunate that sadly it's money that was made and then money that was stolen then from the Robin Hooders, as far as we think how the rules should apply.
Yes.
But because they don't apply that way and nobody's gonna go to jail, it's not gonna be called theft. The money wasn't stolen back from relatives. Right? So the fact that the money was made, then exchanges stepped in to close trading. No, you can't buy more than this, or you can't buy more than that. And then the fact that the stock started tanking, because you can imagine there's lobbying going on the street. I wouldn't be surprised if the same guys that shorted it at $3, when trading was getting stopped at $450, $490, they were already lobbying the CEOs of these platforms, the regulators and what have you, and they knew that trading is gonna stop. What do? You enter a new short, knowing that trading, the buying is gonna stop, because that's exactly what happened, right? Where only selling was allowed. Oh, it was so disgusting.
That's where
it's pervasively disgusting. Where selling was allowed, buying wasn't allowed. So the share price couldn't go up anymore. what's gonna
Yeah,
happen.
exactly,
It's gonna
yeah.
go down. And that's exactly what happened. And we just now have to wait for GameStop to become bankrupt to then start calculating who made the money. Was
Yeah.
the money really made on the other side? Sure, John Smith from...
But surely that's theft, isn't it?
Yeah, of course.
Surely that's theft.
Again, it depends. If you believe in the efficient market hypothesis, it's theft. If you open your eyes and realize that Fat Tony has rigged the coin, it's things functioning as wise people know they function.
Yeah, and for me, what it was funny how, when you read about something,
Yeah.
and sometimes you don't actually see it happen, but this time there's a bunch of things that we were reading about on different books, and we actually saw them happening.
Yeah.
One of the things that sprung to mind as it was happening was a quote on Trading in the Zone, where Mark Douglas says, it only takes one trader somewhere in the world to negate your positive expectancy, to negate your hypothesis on any trade.
Yeah.
And that one person could be anyone. It could be another hedge fund, or it could be a bunch of guys on some social media platform.
Yeah.
And there's this thing of being right or trying or make money in the market. So it's either you want to be right or you want to make money in the market. So it seems the hedge fund managers, by not stopping the bleeding, they obviously they knew that, or at least with the benefit of hindsight, they knew that either an exchange is going to come in, Robinhood is going to come in, because to some degree Robinhood was financially exposed to the trade as well, to kind of artificially drive the price down by halting the buying of the stock. But it seems there's a lot of key fundamental components of successful trading that were broken here, and not only the bleeding wasn't stopped when it was supposed to be. Clearly, these guys were trading far too big.
My friend, it's arrogant at the end of the day. To you and I with our humble net worths, right? It's arrogant. To the guy with 7 billion or with infinite possibilities, it's infinite possibilities. It's literally a I can do anything attitude. And you see, what's difficult now is balancing, even as I'm saying it, balancing the benefits that we get from people that think like that. They're the ones that innovate and create cheap solutions for us to have higher quality of lives. On the other hand, it's the fact that you're gonna get away with it, and that's just an injustice to society. And look, Mark Douglas, that's why he's who he is, and equally so, that's why so many people anywhere in the world can credit him, because he has synthesized the brilliant trading principles that are available, and we can use them to at least lift ourselves some level out of our desperate situations. But to the guy that creates that theory as well, on the side of the actual guy in the arena, those things mean nothing. When push comes to shove, if you own the land, and you own the yard, and you own the house, and you own the room, and you own the couch and the furniture in the house, there's absolutely no level of breaking the law in the house that your son can ever fully punish you for. The only thing that will be left is him appealing to your conscience, and that's why kids cry, for example. So that you can then be a lot fairer in this game that you have. And I think for me that's the significance, for example, of GameStop. It's one of those, there's absolutely no mechanism that you can use to appeal to someone that's hurting you, not realizing that they're hurting you. In the financial sense, capitalism, except in this instance to sort of throw a punch a bit, you know. But more than the punch, actually leave with a message that says, dude, I'm trying to bring attention to you that you currently have made it impossible for us to play this game that you say should be a fair game for everybody, you know. And that's the sad thing. The little guy is always left holding the hope, the
bag is left with the little guy.
Yeah.
And you know, for me, this thing cemented or emphasized the key principles that we were talking about earlier on trading. You know, it's always nice to learn something from someone else's experience.
I was about to say that. Let's actually talk to that lesson. Actually, to say, if you someone that follows Mark Douglas, yes, the hedge fund guy lost his hedge fund, his asset management company from ignoring those principles. You didn't lose your 3,000 rands or your $1,000 account from doing it. Right? And even from his retaliation, you get to record a podcast and speak from the sidelines. You know, if you put some money in, hopefully it's so little that you got the thrill of going up and sticking into the man, while also still preserving your capital and not going out. Because that's the other blessing on the other hand, that if you're a disciplined investor or whatnot, this was a perfect opportunity for you to actually see that you are on the safe side. Mark Douglas actually protected you. You didn't lose money. I can tell you now, you may even find that showing successful GameStop traders is just a ploy as well to make it look like nobody got hurt in this trade except the hedge fund. But when a share goes from 0 to 3 to 450 and then comes back down to 0, there's a whole lot more people than the hedge funds that lost money, you know.
I think it went as high as it went as high as 483. That's
483. But by then there was like a few trades at 483.
And now it's back to around 66. Which is about 86.19%. You can bet that the people that lost money there, and
there's also a whole lot of people that lost money, because here's what I even say because that's a funny relationship that what do you call this, these numbers have on the way up versus on the way down, right? Calculate for yourself how much money would have been made from 3 to 483, and then how much then gets lost on the way down, and who is it that is thing. So from 3 to 480, the hedge fund, I am losing money. But can you hear, I'm losing quantified money. I don't even know if I'm gonna make the point properly, but it's fine. It's not my first language. Right? I'm losing quantified and quantifiable money. On the way down, you have guys that max their credit card to get into that share or to get into that trade at 483. And for them then to lose 86%, sure, we can count that you lost 3 billion, but it's 3 billion in whose hands now that we've lost, right? And 3 billion is the rand amount. What's the value to the 3 billion that has been lost for the little guy? I.e., if you now have a maxed out credit card, that doesn't mean you owe the bank $15,000, for example. It means that you can't live $15,000 worth of what you previously used to be able to in any given month. And that starts to really look very, very scary, you know. You essentially have a self-created market crash.
And I think there's still a bit more Redditors still in profit if they take in the profit on the heart of trading there. But I
listen to Patrick, right? O'Shaughnessy, and I didn't even listen to his GameStop analysis on the Tuesday before the Thursday that we hit 480. Right?
Yeah.
And on the Tuesday, the share was at $89. So if I'm a proxy for the typical Redditor that would have jumped onto that trade after it has already run, right? At $89, which we've already passed, I still wasn't yet in the trade.
Yes.
So it means the person at 66 that is still in profit is most likely the early guys.
The early guys, yes.
Me who got it late, I'm still going to get in. So I long started losing money at...
Yeah, true.
I nearly bought it at $150. That's when educated me could jump into the trade. I shudder to see what other people who aren't as sophisticated, at what price they finally got into them, and they said this thing is going to the moon, let me jump in at $300, and $300 is at the top, so you lose the money immediately.
You
lose the money, you get in, hits a top high,
you buy at the very top, similar
exactly.
to the .com bubble, and bubbles and pyramid scheme have that one thing in common, where the late guys always carries the bag.
With all due respect to the Japanese culture, this was a kamikaze mission where you make a very good point as the little guy, but you the guy that's gonna have lost out in the end. I actually worry about
I hate how a big capital can just step in and just change the rules as they see fit when the rules no longer fit them. But I still am quite curious as to how far the squeeze would have went without changing the rules of the game as we know them, as we want them to be.
And that remains a thought exercise, unfortunately. It would have been interesting, and that's why some of us then took a bit of money and tried to enter the trade. Not because we're dumb, but because you actually, it goes back to skin in the game, I'm able to offer this analysis because I put some money there, and then I start to think, what is someone that did what I did thinking? What are the information sources that they're going through and whatnot? And that's a very interesting prospect. So interesting that it honestly makes a strong case, the same way that the point was made that against the hedge fund guys, that you can't do this, you can't overshort a share, right? There's a similar point. The same energy should then be redirected to the guys that are democratizing investing, to say that, guys, do better. And you've already done a lot, by the way. Don't want to take it for granted, but also do better. I can't now stand on this side of the money, on this side of a loss. And when I consider why I lost money, it's got nothing to do with the hedge funds anymore. It has to do with the fact that you halted my trading.
Yes. Yeah, because they, as you said, the guys that bought in at $100, at $300, or unfortunately at the very, very top at 483.
That last trade.
That last trade. They didn't lose because they were wrong. They lose because the rules of the game suddenly changed on them. And one can say, sure, that risk is always there. Rules in the market always change.
We'd say they should have done their homework.
But you can't you can't expect or anticipate the rules to change that quickly, especially as an outsider, because this was insider trading, always happens, but this was more of an outsider trading.
You see, this is why I'm gonna be brutal, and that's why it's called skin in the game. You can't have any expectations.
Exactly.
You can't have any expectations. So when you say it's not fair for the rules to change or whatnot, that's the part where, and it's sad that it's on your side. That's the part where, equally so, you then get to face the brute reality that it's a jungle. It's not a fair playing field where you get to complain that the rules changed on me, it's unfair, somebody thing. That's why DIY is so difficult on the other hand, because who advocates for you when the rules, someone might not even say they changed, they probably got applied, or they got applied very strongly or whatnot. It's probably more illegal. As I say, the money is going to go and test it.
Yeah. And okay, with especially with GameStop and AMC, we saw Mark Douglas's thing to say your edge can be negated by anyone and that sort of thing. So we've seen that technical analysis can be negated. Fundamental analysis can be negated as well. And Warren Buffett said it quite well. He says, believing in efficient markets is trying to now. The problem with that belief that we have an efficient market, that everything is in price, it equates knowledge with action.
Okay.
So
it implies that everyone that knows acts on that knowledge.
Yes.
When sometimes the price may reflect all the information, but it doesn't reflect all the actions.
Yes, because the price is not moved by.
It's not moved by
it's not
knowledge.
Moved by information or knowledge. It's moved by action and price.
Exactly.
So when because one could also make a case on longing GameStop, and not just by sticking up to hedge fund, but like a genuine case on GameStop. I mean, for one, the evolution of online gaming has been there for quite a while now, and GameStop remains in business. One could look at that as a positive to say they still have a chance to turn this around. Hence, I'm saying that any positive expectancy or any theory or any thesis can be negated by another thesis.
So I'm glad you actually concluded with that, because I wanted to bring you back to that, to say that's true, but that's why probabilistic thinking is so important. To say, sure, just always be aware that you just need one person to negate your theory, right? But ultimately, that's what makes the risk takers, the Buffetts, the fact that over and above knowing that, they also know the likelihood of that happening, the probability of that happening, and then they play those probabilities. So, to your notion of going long on GameStop, true, they have survived, but be careful of confirmation bias. Be careful of, and that's what short sellers are trying to do when they short shares. They're saying that this company has survived this long, despite the fact that they're refusing to adopt new technology.
Yes.
So let's put money on it to close them out, because they are an inefficiency in our market.
Okay.
Right. So let's squeeze them out. Let's short them and take them out of business.
I'm sure no pun intended in that.
You should have been high for that one. But it's exactly that. It's the market playing its role. It's people with information saying, let's not just know that GameStop is inefficient. Let's actually take them out of business. And the long case, it's gonna be a very long case. It's gonna be a tough one, but definitely you can make a case for anything, as you're saying, and you only need one hypothesis to negate it.
Yeah, because even on the short squeeze, you can say, okay, I'm just trying to make a case for the long side of the trade, to say, okay, they've survived this long. Surely there's brains behind the business. And secondly, if we squeeze the shorts enough, the directors of the business can sell a little bit of GameStop to actually then evolve the business.
Yeah, and we all hope that's what they did, by the way. It's all nice and well, and I think they did. It's all nice and well to see your share price shooting the lights out, and then you know the reality of your situation.
Yes.
And you still stay for the ride as if you're an innocent bystander. That would be very interesting to see if GameStop now, at least the executive guys have now made the money to actually start doing what they should have done. But then now you're competing with time. You're competing with compounding effects of innovation over time. So it's not as easy as going to buy Tesla's innovation software, and then you are now a 21st century GameStop. Its practices, its ways of thinking, its mindsets that continue to outplay you. I think what I wanted to touch on is that long case that you make for GameStop. The easy one, for example, is that clearly the people that have been keeping it alive, its customers, are not idiots. Actually, GameStop clients are people that knew a lot about gaming, knew a lot about a lot of stuff. The Redditors that took it to 483, they were not idiots. They were not uneducated people. They're very sophisticated people that solve a lot of problems in the IT space, in the economic space, and they decided to gather their knowledge and resources and do something to hedge funds that hadn't been done before, which is a good case for starting now a long argument or a long thesis for GameStop to say as a start you already have very intelligent, loyal fans,
customers,
and they showed it. They quantified their loyalty.
Yeah. And then it's and I hope I actually hope the pain is not over for the hedge fund managers.
Why aren't you different? In other words, so we all have that wanting to stick it to the man thing inside of us, right? Why I say why aren't you indifferent? In other words, you end up becoming like your perpetrator, where you don't realize that the very things you hated about him, the fact that he was sticking it to poor people or to GameStop executives, you are now doing to him. Obviously, I'm not saying have compassion for someone that lives way above the bread line. I'm just saying be careful of them being obsessed with that and missing the point that there's a lot to learn from it all around. All together, but it's our sense of justice as well. It's, we want to know at some point that something came out of it.
Yeah. And the reason why I'm saying I hope the bleeding hasn't stopped is it like you mentioned that when we participating in the stock market, whether we know it or don't know it, we participating in a probabilistic environment and in a random environment. It shows that even if the hedge fund guys knew that 9 out of 10 times we're getting away with it, there's that one time. And that one time
999 billion out of 1 trillion times.
Yes.
We get away with it.
Yes. And also on I think Nasim touches on this on fool by randomness is there are people that bet on these asymmetries.
Yeah.
And we can't naively just say all the Wall Street bettors were betting just against the hedge fund.
Yeah.
Some of them were just betting against the asymmetry, as you mentioned earlier, that I just have $1,000. In worst case scenario, I lose $1,000.
Yeah.
But best case scenario, man, I make $1 gazillion.
You see, but that for me is the very scary part. And obviously, this is not an investing episode. We're discussing a specific issue. For me, that's the scary thing about whenever you invest for share appreciation. The fact that even say the hedge funds were squeezed out completely and they declared bankruptcy and they're all poor now and sitting next to Robin Hooders and Redditors on the trade, right? Yeah. Now you need to get out of the trade. It's sitting at 400... It's sitting at $480.
Yeah, but to be fair,
$3.
To be fair, because the market is fair.
Yeah, okay.
To be fair, the market. No, with all things being normal, the market is fair.
Yeah,
right?
I say it's itself. I don't know if it's fair or not fair or whether it's called.
That's a better way of putting
itself.
it. Yeah, that's a much
it's
better
true.
way. Yeah.
The market is true. Yeah.
If the share price, shoots to $1,000 from $5, and you are now suddenly a billionaire all of a sudden, and to get out of that position, you need to deal with how that size of a trade gets out of the market. The same way
Yeah.
the hedge fund had to deal with how trading at that scale, exiting positions at that scale, has the impact that the impact exiting trades at that scale has on your own trade.
Yeah.
They would have to deal with that.
Yeah, but here's the thing, or maybe let's put it on. I see that argument and I'm for it 100%. I don't think that's what I'm arguing, right? Remember, for it to get to 483, we agreed that we're gonna take it up, right? So what happens? And remember, how did this start? There's about, you said what? I think there were
1.2 million people.
No, besides the number of people, the number of shares that were overshorted.
140%, so 40 more stocks.
So
40% more stocks.
40% more stocks, right? Yeah, but how many companies did that happen with? Right? It was a number. It was
about 13 or something.
About 13 companies, right? So there's a barometer where you can see that this company is overshorted, right? Then what happens? This happens, and then some hedge funders get out and some others hold on, and some others get out and some others hold on. But I don't know about you, but I, as a Redditor, I never saw that metric. I never saw that bar. So if all of them were squeezed out at $200, I still didn't know. All I knew then was
they were getting squeezed.
Something is happening, and I'm a part of it. And they say we are going to the moon. So in other words, you find that all the shorts were squeezed out at $200, and now there are no more shorts. Now there's momentum taking it all the way up to 483. And what I'm saying to you when I say how do you exit that position, I'm not speaking to the liquidity of it or how do you structure it and what have you. I'm speaking to, okay, now
what's your exit price?
No, not even the exit price. Another topic altogether. What got us here was the spirit of community and the fact that we're in unison.
Yes.
Right? But now we don't realize that it's only us left in the room. Now we're holding, that's why it's called holding the hot potato. Because now all of us are at 483. The way markets work, for someone to be selling, someone else must be buying. So how are we saying we are going to get out of this trade? If we are selling, who is buying? So do we agree then that this half should sell to the poorest half of us should sell to the richest half of us, so that at least some value is captured?
Yeah, and again I come to the point where let markets work the way the markets do. So when
we'll come there, don't run away from that question.
Yes.
I think it's an interesting
so
thought.
let the markets do what the markets do when transactions happen. Right? Granted, we came in as a group, but we were getting through the door one by one.
Yes.
The reason why we were standing outside, we have the same reason why we're getting into the hall, but we went through the door one by one. And we were going out that door one by one.
Who first? Women and children.
Whoever decides, okay, it's my time to go. Because remember, when you are taking on a trade, whether you're investing or you short-term trading, nothing happens until you start, and nothing ends until you decide it's over. At least for you.
Yes.
So you take yourself into the trade and out of the trade. And for all these Wall Street bad guys, no one had a gun on their head and say, Chief, you need to buy Gamestop tomorrow morning.
But do you see, that's where you're betraying the movement now. True, nobody had a gun to their head, but now all of a sudden you're introducing individual elements to this thing that we did together. And I agree with you. Don't mistake me for saying I'm absolving accountability. And that's even why I'm glad I was on the other side throughout the whole episode. Because I'm saying that's something that actually you should rake your brain to answer, to say, and you spot on to say that then it really goes back to Yonke Ndoda's Bonella. You see for yourself now how you get out, but then now that creates that creates the same problem that got us here anyway, where now people are gonna rush to get out first, make the most money. Now we're gonna hate them for driving the price up, and slaughtering us, because especially when it, for example, if we find that it's Elon Musk and Mark Cuban that got out first, then it starts to look suspicious. It starts to look as if we gave it to the hedge fund guys, but the individual billionaires just used us to effectively make even more billions because we still left holding the can.
And hence of saying that, that's how markets work. You in a trade, nothing stops until you make it stop. And nothing starts until you're making stop. And the reason why I'm saying that is not to say Redditors would be dumb or Redditors are dumb or hedge fund managers dumb. That's the rules of the game. Nothing starts until you make it start, and nothing stops until you're making stop. And it shouldn't change neither for the hedge fund guys nor for the Wall Street bank.
But then you're saying you're okay with it having changed to squeeze out the shorts.
Nothing changed there. The rules didn't change. The rules were as they were. Because it wasn't necessarily insider trading.
Okay.
It was just...
so you're saying the guy that gets out first at 483 deserves to?
Yeah.
Because
that's the point where they say, okay, the game stops for me here.
Now, okay, I'm gonna then hold you to a higher accountability. To say, I hear that. We can't ignore the fact that we're going to end up with, again, a horrible situation where poor people have lost a lot of money, right? Why is it okay there and it wasn't fully okay when the hedge fund guys were shorting a share 140% and saying, we don't care who we hurt, this is the way markets work? Why is it okay now when it's time to exit this trade to have that individual capitalist ethic now that says, but this is the way the market has always worked? What isn't that the exact thing that we're trying to attack?
Yes.
When it comes to capitalism and Wall Street, say we're trying to fight this thing where we are just hurting one another with abandon, and the person that has the most resources gets away with it.
So remember, they took advantage of the US regulations that allow naked shorting.
Yeah.
In other words, selling a stock that you didn't physically borrow, because you can only borrow 100%.
Yeah.
And then sell it to the market.
Yeah.
They work within those rules.
Yeah.
Right, which is great, good for them, and they I'm sure they were profiting for some time until these guys stepped in. What I'm saying is, if like the rules that got them in should be the same rules that gets them out of that position.
Yeah, they got squeezed
and
out
as much,
at 200. I'm speaking to the little guys that are now at 480.
The rules still haven't changed because that's how markets work.
Yeah.
Because who are they selling to? Another short seller who think, okay, this is too high.
No.
And if that short
seller is selling.
Yeah, remember,
he's not buying.
Yeah, the short sellers were squeezed out, say 200.
Yes.
There's a new short seller at 500.
Yes.
This thing is crazy.
But he's selling, he's not buying.
Yeah.
He's going to buy. He's creating a contract that says he will be expected to buy this share and give it to someone.
Yes.
Yes.
So they're selling the driving the price down. So these guys need to sell some more.
The Redditors still need to sell and get out.
The old Redditors are just selling to the new.
The suckers. Yeah. The latecomers.
Yes, because...
So in essence what you're saying... So in essence what you're saying is... And you're going to owe me a chocolate for this. Or a blunt. I don't smoke, mom. I really don't. Yeah, you saying to me that the guys that started this rally deserve the money that they're getting because they were taking out the short guys, right? The guys that are buying it at 480 deserve the loss because they are greedy. They are just climbing on a moving train.
Yes, in a sense, because okay, let's first go back to let's first go back to the basics.
Yes.
Who buys from a bull who's in profit. Either a bull who wants to jump on that train, or a short seller who wants to stop that pain.
No, a short seller doesn't buy.
I mean, a short seller who's covering his position.
Yes.
So there's two sets
people
of
that
buyers.
buy from the
New bulls and
someone covering their
bull.
position. Herd bulls. Herd
bears. And who sells to a bear who's exiting their position? A new bull who thinks they're right. Or rather a new bear who thinks this thing is still going even lower, or a new bull who's a herds bull, right? So at 483, either a new bull is entering the market, because what I'm getting at is the rules shouldn't change. That's the rule.
I agree with the rules shouldn't change, but
or an old short seller is covering.
But in fact, I'm holding us to an ethic that says you and I know that it's not bulls and bears doing this. It's people. And the fact that now we've reverted to calling them bulls and bears show that there's a level of hurt that we don't want to be associated with. So let's then revert back to the jargon of Wall Street that absolves us of analyzing that we are saying that it's okay for the little guy to take the can.
But when you see the market, the nice thing about the market can be both. It's a casino, but you could be a gambler or the casino. You decide.
But I'm saying to you that when we were sticking it to the man,
so when it
wasn't this clean.
Whether you are sticking it to the man or not, when you late, remember the .com bubble. Remember the .com bubble. There were late people that went into the trade and they got hurt. 2008, there were late people that
but it's not
that
the
went
same.
into that trade.
But it's not the same. In this case, a specific point was being made. This is a specific transaction. That is why we're excited about it, because it's not 2008. It's not 2000. This is a bunch of smart guys that decided, let's stick it to the man. Then a bunch of poor guys, myself included, that decided, oh shoot, this is a nice moving train. I also want to make a quick buck from it. And again, don't get me wrong. Like, I'm dignifying your analysis to say that the people that are going to be hurt at the end of the day should understand that it's okay, not in a careless manner, as in we don't care about livelihoods, but it's okay in that when greed stepped in, or when the fact that we're making a good point didn't absolve us of doing our due diligence, didn't absolve us of the rules that we already know, the principles that are always in application, such that the guy that realized that this share is overshorted more than the available shares, he identified not only an opportunity, but he also knew that, or rather off the record, he knew that there's arrogance going on for you to short a share this much.
Yes.
And he then took advantage of an opportunity first, and secondly, also made a point to say you never do that to a share.
Yes.
And then that position started closing. So it went from being 140% shorted to less until where it switched and it was less than 100%. And up until all the shorts were out and they had covered the position.
Yes.
Let's hypothetically say that happened at $250. You, Basin Island, I have a friend called Basin Island. You, Basin Island, who gets in at 250, who knows how this thing started, but does not do the research of checking, has the point being made, and you continue to just put your money in there.
Yes.
My friend, if you and I are honest, over a glass of ginger beer, you doing it for greed now. You doing it hoping that you're gonna, since there are these intelligent people that are taking it to 1,000, and now I'm not part of their community. So now we've moved away from hedge funds. We've moved to a new crowd now.
Yes.
You trying to take advantage of them. You trying to say, okay, since they're going to 1,000 and I'm poor, I just need to double my money.
Yes.
And I'll be
fine.
out.
Yeah.
You saying that, okay, I'll get in at 250 and get out at 500 on their way to 1,000, and you cleaning your conscience by saying, I didn't hurt anyone. They were going to 1,000 anyway. It's just I really needed to pay off my bond or my mortgage or whatever. Because I think that's what you're seeing now being left over.
Yeah.
You're seeing people now saying, please come back. Let's take this thing to the moon again. And it's probably because they left holding the can and they're trying to say, please don't leave me here alone, broke.
Yeah, and I think it goes to another principle Mark Douglas touched on trading in the zone. Guys, you should actually get that book.
Yeah, it's phenomenal. I haven't read it, but I've been in the space long enough to have got all the lessons through you guys. Yeah,
it's a brilliant book. But one of the key things that he touches on is on risk, right? Yeah. There's knowing risk and there's accepting risk. And those are two fundamentally different things. Yeah. Right? So you getting at 250, you just know the risk that this might go back to zero. You know the risk. Yeah. But now you need to accept that risk. Yeah. Right? Yeah. Hedge fund managers knew that this thing could go to the moon. They know that risk, but they need to accept that risk. Yeah. And you know, accept it and don't be a crybaby after the fact. Yeah. Wow. Well, you see, if I have the resources to be a crybaby, that's part of me accepting the risk. If I have $1 billion to throw at you, it's part of me accepting the risk. You're not accepting the risk. You want to change the rules of the game. You're limiting the terms accepting the risk, and that's because you believe in fairness and and I understand why in true free markets. Yeah, in true free markets. And for as long as I have money and I can throw the rule book at you, that's part of true free markets. Yeah, we have unequal participants in the market, and true and free will mean different things depending on how much money you have. Yeah, yeah. And for me, you know, that knowing and accepting of the risk was cemented to say, okay, I know my risk. I know a 5% drop on this share is my risk, and I accept it. Yeah. If I take anything more than that 5% drop, then I didn't really accept that risk, did I? I actually, do you know what I think I'm going to be looking out for as the news keeps unfolding? Mm-hmm. At which point all the hedge funds were out. Because if they were out, hypothetically, let's say at $100, that's a phenomenal piece of business. Because you still lost a lot of money. Yeah, but that bleeding stopped. Yes, but that bleeding stopped, and it stopped way before it would have gotten to 481. Yeah, I honestly don't think they went out, at least not all of them. Yeah. Because they could have gone out and come back in. Yeah. Like, the reason why I'm saying this is as the show was skyrocketing, there was a lot of it was funny, actual crying on the news by these guys. Yeah. You see, again, are you crying because you're still in the position, or you crying because you've already lost so much by having to exit the position? It's again, I suppose you're right that it will be interesting to see where at least all of them or most of them or because remember from $3 to $9 you've already lost 300% of your money. Yes. By the way, from $3 to $90 you've already lost 3,000% of your money. So you could be crying for that. And not crying because it's at $400. No, you're crying because you still need to go find 3,000% of 7 billion. So as we close, man, what were your lessons on this particular trade? Look, I was fortunate that in December I was writing an exam, and one of the things they asked us to research was sustainable capitalism. And when this was happening,
I could understand exactly what was happening. When Black Lives Matter was happening, I could understand exactly what's happening. And it's scary for someone who's in the industry. I aspire to be an asset manager because there isn't as much level of franchisement that you can have anywhere else. In other words, the power to affect your living standards than being an asset manager. You know, capitalism depends on money, and being a capitalist, being an asset manager, you the person that handles money itself. But the biggest lesson that I took from my exam and then from seeing this playing out is this breed of asset managers coming in should not ignore the fact that capitalism has a lot of positives, but it clearly has a lot of negatives that people are crying out in each different way that capitalism plays itself out, that we need to fix those things. So through Wall Street, they did the Gamestop trade. Through everyday relations and killing of people because of the profile, demographic, be it because they're black or because they're poor. But Black Lives Matter happened. Through the Me Too movement, where we are seeing that in sexuality, capitalism is also there, sticking to it to us. We're saying that we are not happy with you saying that if you work hard, you will get to the top. But you say to a woman, for you working hard includes sleeping with the guy at the top. You know, and there are so many now of these different types of movements, such that as an upcoming asset manager, I'm seeing it as it's an inequality movement, just showing itself in different thing. You know, on Wall Street, there's an inequality of resources or inequality of applicability of the rules. In corporate, there's an inequality of power dynamics. On the streets, there's an inequality of applications of the law. So I think that's the first and biggest lesson that I've learned, that I need to build different models. I need to incorporate a level of philanthropy, not in the sense that I want a library named after me, but in the sense that it's not complete until it recognizes limiting the damage that it does to other people. That's the one. The other, hey man, don't get in front of a moving train. You know. The other as well is being a liquid position and in a comfortable enough position that so for example, I'm fortunate. I barely lost any money. I didn't put on GameStop, I put on Nokia, and they had results a few days later. It's still quite a good company, what have you. But it was a negligible amount. I think I put less than 1% of my portfolio in Nokia. So that I also appreciated learning that I still need to have a little side money to be able to participate in these sorts of things. And then the other one, the other lesson is things like don't ignore the everyday rules. Panic quick, so when the tide turns, get out. And also, there are no rules sometimes. There really are no rules, and understand that you just need to be loyal to yourself and truth, and everything else. Don't have expectations of the market. Nobody owes you anything, even the very people that are rallying alongside you to take something to the top. When it's time to panic or get out, they're gonna be true to their stomach. They're not gonna necessarily be loyal to the pact that you had.
I really I never really thought of it in that broad aspect that you've put it on. This is just another inequality battle with race, with capital, with gender dynamics, gender-based violence and that sort of thing. It's another form of
it's another form of a protest.
I never really thought about like that. I always looked at this trade as a trade.
That's why we love it. That's why we love the markets. It has phenomenal life lessons the more you go.
And I suppose it was a kind of a good thing that both sides were hurt. both the short and the long. Somebody got
not if you're on the poverty line. Philosophically, it is good that both sides.
And the reason why I'm saying it was good that both sides were hurt is when people coming into, especially in this trending securities, Bitcoin, Dogecoin, Gamestop or whatever. Whenever you jump into a trend where you're risking capital, this can happen to you. Whether you learn that lesson or not is irrelevant. But at least you know that this can happen to you. Something like Steinhoff can happen to you. And something like Steinhoff can happen to even the smart guys. So it's not just you. When you find yourself in a losing position, it's not that you're dumb. It's just that you're in a wrong side of the market in that particular time, and it breaking the basic rules of trading and participating in the markets will hurt. I think that was my biggest lesson. That breaking the rules of the basic rules of participating in the market in a risky, random, probabilistic environment such as the stock market or any liquid market for that matter, and breaking the rules of that or that will get you to be successful will hurt. Not cutting your losses short will hurt. Trading too big will hurt. Being greedy will hurt. Not adhering to your stops will hurt. And the stop loss thing is funny because from time to time you will get stopped and you'll see the market goes into your direction. And also there'll be a time where you'll get stopped and it will continue in that opposite direction that you said it wasn't going to go. So it's very profitable to define your risk, and when your rules have been broken, i.e. my rules are on, as a short-term trader based on price, your rules are based on the balance sheet of the company. Once your rules that you make, because we make these rules, we just I decide that I'm going into the trade, and the reasons why I'm going into the trade were all made by me. Whether I copied it from someone else, once I apply it, they now my rules. Exiting a trade also based on your rules being broken. Right. Whether those rules you borrowed them from someone or you made it up yourself, breaking your own rules will hurt more than breaking the market's rules.
Of course. It will hurt. I think it was Lincoln or something that said rules govern the lesser men, moral conduct the higher men. And in other words, if you hold yourself to a higher standard, you always come out cool. But I think in the same vein, there's a business partner I'm busy. I don't know if I'm fighting with him or he heard me, but he also taught me a lesson. He once said to me, "You can't fake being a gentleman." And I think it's one of those, when you're obeying your rules, whatnot, I think that's another lesson that I took, always have your sense of decorum. If you're going to teach someone a lesson, teach them the lesson and stop. If you're going to be greedy to a point where you say, this is enough, and then stop, And if you think you're going to fake it, one day you'll be exposed. You can't fake being a gentleman.
As they say, you can cross the highway with blindfolded. You can get away with it, but one day you're going to pay the price. Let's park it there. Thank you, my man, for borrowing us your time. I think this is the first time I see you in the new year. Happy New Year.
About 2 years, probably, maybe 3 years.
It's been a minute.
So happy couple of New Years.
It's been a minute. That's it for the show this week. Thank you for hanging with us. Check you next time on The Village Trader. Be sure not to miss another episode of The Village Trader by subscribing on your favorite podcatcher. We're everywhere where decent podcasts are aggregated. Do join us tonight as you're listening with myself and Simon Brown. Follow the Trader webinar link to that Zoom on the show notes below. Thank you. Check you next time on The Village Trader. Cheers.